Hi, everyone. Thanks for tuning in to Passport to Wealth, the podcast that takes you on a journey through navigating your finances as a U.S. expat. I'm your host, Arielle Tucker, a certified financial planner and enrolled agent focusing on cross-border planning for U.S. expats. And I'm joined by my co-host.
I'm Savannah Chafin, a CFP candidate, enrolled agent, and self-declared expat tax nerd, here to guide you through the maze of life and finances across borders and share the inspiring stories of fellow U.S. expats who have navigated the process.
Good morning, Arielle.
Morning, Savannah.
And hi, everyone, and welcome to the next episode of Passport to Wealth. Today, we're diving into a topic I find super important and really key at this time of year, and that is end-of-year tax and financial planning opportunities.
Yeah, I mean, the end of the year is the perfect time to assess your financial goals and take action and save on taxes for this year, 2024. We're still in 2024, and so we can still make some changes. So whether you are a seasoned expat or just starting on your journey abroad, these strategies can help you finish the year strong. So let's jump in, Savannah.
Yes, so let's start with charitable gifting. So this is a great way to align your financial plan with your values. So this is a key point for any people who are filing a U.S. tax return and itemize your deductions. So the only time you're ever really able to claim a deduction for charitable gifting is if you do itemize your deductions. And there are some different strategies to consider there. And the first one would be charitable bunching. So this is instead of spreading your donations out over multiple years, which you likely wouldn't receive a deduction for if you're not itemizing, you can consider bunching several years worth of donations into one single year to exceed the standard deduction, itemize your deductions, and then get a tax benefit for that.
Yeah, I mean, that's one way to do it. I think we really have to just talk about, I'm like quickly Googling the standard deduction. So the standard deduction for 2024 is $14,600 for single filers, and for those those who file separately as well, they have the same. And then if you are a joint filer, the standard deduction is $29,200. So I get this question all the time. I would like to donate $5,000 to my alma mater. Okay, awesome. You will get no tax deduction for that, right? Like there's no tax deduction for that. So really, because the standard deduction is so high, and if you are living abroad and you don't have a ton of mortgage interest and you don't have local taxes and you're not itemizing or you don't want to itemize, then we really want to think about how to give strategically. Again, if you just want to give $100, $1,000, please just go do that and don't stress too much. If you want to give more, that's where we want to think about charitable bunching. Or what I really like to do is we go through and we look through your investment account and we see, okay, do we have some appreciated positions? Maybe you bought Apple when it was, $50, and you've just held it. And we decide, okay, maybe we want to give $2,000 worth of Apple stock, and we can gift that stock directly to a charity, and we don't pay any capital gains on it, right? And so that really becomes the planning opportunity. It's less about maybe just giving cash. I don't want to give cash. I want to give my appreciated positions to the charity. The other thing to really consider for U.S. expats is right now we are talking about U.S. tax. We're talking about U.S. tax. And so we have to consider charities that are registered and qualified under U.S. tax law. There is actually a website, Savannah, let's be sure to put that website in the show notes, through the IRS, where you can actually check to see, is this a registered U.S. qualified charity, yes or no? A lot of times, if you are living abroad and you are, building up goodwill in your local community, you may want to give to your local community. That is, again, it's not going to be a qualified deduction for U.S. tax purposes. If you're living in a high tax country, it may make more sense. There may be some tax incentives from your local country to give to a local charity, a local qualified charity. So it's really important to just take a moment and think through, who do I want to give to, and who will I get the biggest tax deduction from? Maybe the U.S., it may be your local country, but think about that before you gift.
And I think that's a really key point when you were talking about like the tax rate in the other country, right? Because if you're living in a country with a similar tax rate to the US, you might need all of the foreign tax credits you can get. And if you're making a charitable contribution and it's lowering your foreign tax rate, that could actually lead to you paying more tax on the US side because you can't claim the deduction on that side. So that's an interesting point I haven't really thought about before. But another good charitable giving strategy is qualified charitable distribution. So this is if you're 70 and a half years or older and you have an IRA, you can donate up to $100,000 directly to a qualified charity. And doing so also counts towards your required minimum distributions and is excluded from taxable income.
Yeah, one thing we might want to check there is with the Secure 2.0 Act, that number, the qualified required minimum distribution age jumped up to 75. And so we want to check that number and put that in the show notes. I'm just noticing it says 70.5, and that was the old required minimum distribution. But for sure, there are some benefits. If you are like, oh, I have so much money, I have to take a required minimum distribution, we can look at giving that directly to charities and then excluding that from your taxable income.
Yeah, and the next key point I wanted to talk about is managing your capital gains and losses. So the end of the year is an excellent time to kind of go through your investment portfolio, rebalance, see if there's any positions that are sitting at losses that you can sell to take advantage of capital tax loss harvesting. So what is tax loss harvesting? That is when you have positions or investments sitting at a loss and you sell those, you can claim those losses on your return to offset other investments or to carry forward to future years. So any of those capital losses that you can carry forward can be used actually to offset your ordinary income. So you can use $3,000 per year or $1,500 per year if you're married filing separately to offset your ordinary income. And then any other losses can be carried forward to future years to either offset future investment income or to claim that $3,000 or $1,500 each year towards your ordinary income.
Yeah, and some people get really nervous when we start mentioning this idea of tax loss harvesting. It's like, well, aren't I losing money? Not really, right? Because this is especially important to consider, right? Markets go up and market goes down. Overall, the trend is that they go up, but we will sometimes have some pretty intense years. I mean, you just think back to a couple of years ago, COVID year, where the market just dropped 30%. If we kind of capture that loss, as long as we're buying similar but different investments, everything is down. And so we're just kind of locking in that loss with the idea of, okay, we can reduce our US taxable income with that loss. The important thing to know is, let's say you have built up $65,000 of capital losses, and now you're looking to move abroad. Your new country of residence may not recognize all of those losses. The U.S. will continue to recognize those, but your new country may not recognize those. They may have different rules around capital gains. They may have different capital gains tax rates. So you kind of always have to be layering in. We have the U.S. planning, but now we also need to consider what is the local country rules that we need to think about.
Yeah, and while you're kind of reviewing your investments to see if there's any tax loss harvesting opportunities, it's also important to make sure your portfolio is staying within balance. Like if you're invested in a target date fund, right, that automatically rebalances for you. But if you kind of are managing your own investments, it's important to make sure you're staying in line with your target allocation. And I wanted to quickly jump back to what you said, which is if you're selling investments, buying something similar but not exactly the same. And that is something called wash sale rules. And that means if you sell a certain position and then repurchase that exact same position within 30 days, you actually can't take the loss. Like the loss is disallowed. So it's really, really important not to do that.
Yeah, Google drops, you buy Google again, you don't get to capture the loss, right, if you do that within 30 days. So it's important that, again, you really are thinking about what am I replacing this with to make sure I'm actually being able to capture that loss. The other thing, just thinking about foreign countries that we want to be sure to discuss is if you have foreign investment accounts, right? A lot of our clients do have foreign investment accounts. We want to consider PFICs, so passive foreign investment company rules. And this basically a lot of times gets triggered once you start buying foreign mutual funds, foreign ETFs. And I say foreign as a non-US. A lot of times those can trigger additional US tax complications and taxation.
All right, the next point I wanted to dive in today, and that is retirement planning. So this is essential. Even when you're living abroad, you really need to consider what you're building into retirement accounts, like what funds you're building up, how the nest egg is progressing. And there are a few kind of end of year opportunities to consider in that regard. The first is maximizing your IRA contributions. So if you have earned income and you qualify to contribute to an IRA, don't forget to contribute before the April 15th deadline. So the April 15th deadline is to make 2024 contributions. And that amount is $7,000 per person, or $8,000 if you're over the age of 50 or 50 or older. And then contributions for 2025 open up in January. So make sure to write that in your calendar so you can go ahead and make that contribution then.
Yep. And I think this is so important is sometimes when, we get into moving abroad, life can feel really unsettled and maybe it feels very transitional. That can happen. It can be transitional for a very, very long time. And so it's one thing if you take a break from retirement savings for a year or two, but if you are still feeling like I'm still in transition and you're waking up and it's year 5, 6, 7, we have a problem, right? You still need to prioritize future you, even if you feel like life has just been transition, because you will wake up and you won't have anything saved and you'll be like, well, it just felt really crazy for the last decade. It can feel like that, but we still need to figure out how you're going to save for future you. So again, great point, Savannah, maximizing the IRA contributions. Another point we want to consider, which may work well for expats or not, depending on which country you are in currently, depending on which country you are planning on retiring in, Roth conversions. So again, if you're in one of those transitional years and you're like, man, my income was really low or this year, and we're not expecting it to be, this low, then it may make sense to convert some of your traditional IRA funds to a Roth IRA. That could really help lock in those lower tax rates and allow for tax-free growth, which can be really, really powerful. Just remember, not a lot of countries recognize Roth IRAs. So you just really want to think about, well, where am I going to end up? And how is the country that I'm currently in, how will they tax this rollover? That's another good question to ask. And then finally, we want to think about those catch-up contributions. So like Savannah mentioned, if you are over 50, try to take advantage of those catch-up contributions. If you still have access to a U.S. qualified plan, maybe you're self-employed, you have access to your own solo 401k, you have access to a SEP IRA, try to take advantage of those catch-up contributions. If you're like, man, we've been in transition for a long time, okay, now we need to play catch-up. Those still can be great places to save. Depending on which country you are in, you might even want to look into what your local country is offering. Sometimes you'll be able to make, catch-up contributions into an employer plan. Just be sure to check the rules. What is the U.S. going to say if I make these contributions? Is that a tax? Is that tax deductible? Am I going to be paying tax on this twice? I don't know. Be sure to check the rules for the country that you're in.
Yeah. And some other year-end strategies, one that's kind of top of mind right now is reviewing currency exchange rates. So after the election results, the US dollar became much stronger as compared to the euro. It became stronger in general. So if you live in a foreign country and you have a lot of holdings in USD, it might be worth looking into trying converting some of that into your current currency. So yeah, that's a good thing at the end of the year to review exchange rates. If it's high, consider moving funds into a different currency or, developing a plan for how you'll do that in the future year.
In general, as US expats, we always want to be if we are earning and living in one currency, we want to make sure that we have like for sure are short-term needs in that currency. So if you are, let's say, living in Germany and you want to buy a car, but your savings to buy that car is in dollars, we want to bring that money over into euros if that's a short-term purchase. In the next year, we're going to be buying a car. Wait, we need to work on a plan to move that money over into euros because we don't want it subject to currency risk. Currency risk is like market risk. It's just another risk that as US expats that we have to live with and manage for the long term. Yes, the dollar kind of had a bit of a peak. The market jumped. The dollar went up against various currencies right after the election. We're already starting to see that come down. And if we think about what Trump wants to do with his policies, we know Trump really likes having a weak dollar and a strong stock market. So it will be, again, these are things that we cannot predict. We can just see what the patterns were in the previous administration and then just kind of do our best to like hit the target and hope that we're right. But the biggest thing here is managing currency risk, keeping the money that you need. If you're already retired, I would say have 3 years of expenses in your local currency. That would be my target if I was already retired. I was already living on off my investments and my retirement accounts. I would want to have at least 3 years in my local currency if that's not in USD.
Yeah, and if you potentially find yourself in the case that you are owing a lot of US tax, it's important to make sure that you have USD to pay that US tax on the US side. So yeah, start looking at that ahead of time as well.
Oh, and we see this all the time, right, Savannah? Like, you are earning in a foreign currency, the currency gets stronger. You may have made the same amount of money in the foreign currency as you did last year, but that currency is now worth, 5-10% more. Okay, well, that just bumped you up in a higher, marginal tax rate from a U.S. side. We owe more tax on the U.S. side. So again, when we're thinking about how much do we want to have our emergency fund, our short-term reserve in our local currency. But on the flip side, on the U.S. side, how much money should I be keeping in USD? I would want to find a high yield savings account, and I would want to be, most people are still going back to the US maybe once or twice a year, maybe more. They still maybe have subscriptions in the US. We still want to keep maybe like a full year of funds available in USD to pay for those subscriptions. So we don't have to constantly be, moving funds unnecessarily or trying to tie, a certain currency.
Yeah, it would especially, like I was saying, if you're expecting a tax balance, it would suck on like April 15th, realizing you owe $30K and then the exchange rate being terrible and having to convert it all into USD. So planning ahead is good.
Yep.
And the next one I wanted to talk about was kind of estate and gift planning. So the end of the year can be a really good time to consider these. And one is the annual gift exclusion. So you can gift up to $18,000 per recipient in 2024 without it counting towards your lifetime exemption. So this is a really great way to reduce your taxable estate and start spreading it out to your beneficiaries while also helping out your loved ones.
Yeah. And I mean, that's per gift. So it's $18,000 per recipient. So, if I wanted to gift to all of my kids, my husband could also gift to all of our kids, basically doubling that exclusion. This becomes really powerful when we think about 529 accounts. If you have grandparents who are have a big estate and they are very charitable inclined, they can actually make a 5-year gift in 1 year. And that annual gift exclusion will jump up to $19,000 next year. So that's indexed. But again, it's important to consider what, the local resident country considerations. Your local country may not allow you to just make an $18,000 annual gift exclusion per person without any reporting obligations. So this is, again, on the U.S. side. It's not a global rule. It's just a U.S. rule. So always consider the, what the resident country rule is.
Yeah, and then it's always important just to make sure that your beneficiary designations are up to date, that you have the right beneficiaries listed on all of your retirement accounts, both US-based and foreign. That goes as well for any insurance policies, any other foreign investment accounts. Just making sure your beneficiaries are accurate and up to date can really save your family some headache later on.
Yeah, and I mean, again, estate planning can be notoriously tricky for expats, right? Who are you married to? What are their citizenships? What are your citizenship? What residency country are you in? Do you own property? How do you own your assets? Again, this stuff is really, really individualized. I would not be trying to Google my way into estate planning. This is where you want to find a really good international estate tax lawyer.
Definitely. All right. Well, we are almost at time. So that is it for today's episode on end-of-year tax and financial planning opportunities for U.S. citizens living abroad. So I hope you'll take a little time to think about these and how you can maybe implement them into your lives. And if you have any questions or need personalized advice, we suggest finding a professional who can support you. We also offer calls on our website, a 45-minute call with a 15-minute follow-up. Those are paid consultations. You can look at our website if you would like more advice from us. But yeah.
Yeah, thanks for tuning into Passport to Wealth. So don't forget to subscribe, leave a review. That really helps us out. And share this episode with fellow expats. See you next time, and happy planning. Thank you for tuning in. Stay tuned for our upcoming episodes packed with insights and stories to empower your global financial journey. This is Passport to Wealth, where your financial future knows no borders.
The information provided in this podcast is for informational and entertainment purposes only. It should not be considered professional, financial, or tax advice.
We strongly recommend consulting with a qualified financial advisor, tax professional, or other appropriate expert before making any financial decisions or taking action based on the content discussed in this episode.
Your personal financial situation is unique, and a professional can provide tailored advice to meet your specific needs.